So what we're going to look at today is a very, very brief overview of what the ecosystem is like, followed by a bit of an insight into what the investor thinks. Now, as a representative of an investment firm myself, I can sort of take a look inside what our approach could be. But more importantly, this is not completely dissimilar to what the investment approach is amongst the venture capital and angel investment community. So there's some pretty good general guidance there. Look at some of the key criteria and especially what you should focus on when it comes to getting that investment secured and making sure your business is prepared for that investment, because there's nothing more embarrassing than walking into something half prepared when you could be using some really good information to get that upfront info on what you need to be able to attract that investment. So first up, let's look at what the ecosystem looks like. Those of us who joined us last week for the angel investment webinar would know there's lots of different players and it's a pretty big system, but the biggest markets in the world aren't the only markets. We tend to think of Silicon Valley, and they are by far the largest. So we're talking about that area around San Francisco, San Jose, Santa Clara, Mountain View, Palo Alto, where the Googles and the Facebooks all seem to begin. But while Silicon Valley is the biggest, others include New York City, London, they're about equal number two, LA, Tel Aviv in Israel, and Boston, Massachusetts as well, all very large areas where startups seem to be bubbling up. Now, is that the end of the story? Absolutely not, because Sydney's in at number 20 when it comes to those ratings as well. So whilst not in the top 5 or 10, we're certainly in the top 20 of the largest startup hubs in the world. Melbourne then comes down very much after that. But as you can see on the map there's lots of little startup hubs around Australia, including up in Darwin. We've got some in Adelaide, a couple there, Melbourne, Sydney, Geelong, Launceston, would you believe, has a small startup hub as well. Townsville, Cairns, all these different locations right throughout southeast Queensland feature quite vibrant little startup hubs that are there to connect investors with opportunities, but also to help prepare people for that investment too. So if we look around Australia, what does it look like? Well, it's one heck of a big network. We're talking about the entrepreneurs themselves, the people who are looking for the money. Then there's private equity firms, and I'll explain what they are very shortly. Angel investors, sovereign funds, which usually represent nation states, venture capital firms, startups themselves, the incubators and accelerators, which are usually just places that help to make those startups ready for investment and certainly get them ready for true commercialization, rather than having a little bit of an idea that they're sort of bootstrapping along to themselves with their own savings and the bank of mum and dad. There's also business networks from chambers of commerce right through to those peak bodies. And then there's government programs and grants. Here in the Northern Territory, we have the Business Innovation Program specifically, which works with this. And then banks and financial institutions do actually work with startups. I had a great conversation with the Indigenous lending manager from Westpac Bank here in the Northern Territory, who does actually have startup loans for Aboriginal businesses that are starting up. And those loans, of course, are available to other people as well. But, of course, being a bank, it's a little bit different than as a risk profile than what it would be getting someone, say, from an investment firm to come in as a partner with you. So what we're going to focus on is three specific areas: the areas that impact private equity firms, angel investors, and venture capital firms. And those three, if we look at them a bit more closely, private equity firms are more interested in taking control of your business. So this tends to kick in when there's a lot more momentum in your business. You could be 10, 20, 30 years into your business, and a private equity firm could come in, often to a business where, say, the founder is wanting to retire, or it could be a distressed business where it's just sort of stuck. It can't get any further or might be in decline, and it needs the expertise that a private equity firm can bring in. This usually involves a majority shareholding. So it's generally a buyout or a takeover, at least of control, to bring that back into it. Now, the original founder may still be involved. There may be co-investors, smaller investors in there. And quite often with private equity firms, you'll also have management involved in the ownership as well. They'll take an ownership stake in there as well. The idea being, if the management are really part of it, then there's a great incentive for them to turn that business around. Angel investors, which are usually the earliest of the early stage investors coming in after the bank of mum and dad, basically, or they may actually be the bank of mum and dad in this case, will come in and they pretty much always take a minority shareholding, simply because their contribution being very early takes the greatest bigger risk, but they're not usually interested in controlling the company. But one thing angel investors do provide is a lot of expertise. They come in and partner with you to get that thing going. So you're so early in this, you probably have no idea what you're doing. And then they'll provide their operational expertise, their growth and sales expertise, as well as sometimes some technical expertise as well. And then the venture capital firms. This is the part that we probably have a clearer understanding of because we've seen Shark Tank, right? That's usually where you see venture capital firms coming in. Now, they usually take a minority shareholding of a business. They're not really interested in taking the ownership or not even taking that ownership over a long period of time. They're there to get not a short-term result, but it's quite often not a 30-year investment, put it that way. Private equity firms, pretty much the same. They're only in there for a limited amount of time, turn the company around and be able to offload it at a considerably larger value than what then they bought into it. So venture capital firms, again, very early stage, maybe a little bit after the angel investors or coming in around about the same time, but they are not individuals as angel investors tend to be. They are actual firms, institutions that participate in that. Now, private equity firms and venture capital firms have investors in them as well. So while they're investing in you, they've also got a set of investors that put money into these funds that then these firms then go and distribute out to various investments. They've got a trusted relationship with those investors, often with very long-term arrangements with them. And those investors can range from anything from corporations to pension funds like superannuation funds. They could be financial institutions like banks, insurance companies, or they could be private individuals coming from family offices such as family trusts. So there's a lot of complication in there, but what you really need to know is these are kind of your three main investors when you come into this sort of stage of wanting to grow your startup. Your angels usually come in at a low amount very, very early to help you get over that first set of hurdles. Venture capital tends to come in to help you to commercialize and scale yourself. And private equity tends to come in later down the track to a more mature business simply because you need to either retire or you're looking to turn around a business that's not performing, and they've got very good expertise in that area. Now, when it comes to 2024, we see some very, very significant trends emerging. I'll start with the AI related tech because we can all relate to that. I've been using AI all morning this morning to help to sort of summarize and to extract information out of very large bodies of government legislation and work to help out some of our clients who are in the startup world themselves. AI related tech is hot right now, but it is starting to sort of move away from that as we realize that the big platforms, Google, OpenAI, looking at like Claude and Anthropic and even Meta through Facebook and then their different AI related tech as well, are sort of kind of cornering the market there. The AI related tech, while it is hot right now and sort of dominating the conversation in venture capital and in angel investment, especially for things that do very specific things that really people are sick of doing, well, then there's a lot of conversation around that. Government incentives seem to be running hot right now. Everywhere around the world, government is trying to attract new startups to get innovation and entrepreneurship expanded as they probably realize that inflation, the cost of living everywhere around the world has gone to such a point where people need to go beyond just simply relying upon a full-time job, and they probably need to get into, expanding their money quicker. And the best way to do that is probably through investment or creating a business that goes beyond them selling their time for money and getting a multiple on that. So instead of saying, well, I'll sell 38 hours in my week for $100,000 a year, you're talking about, well, I actually want $1.5 million a year, but I don't have enough hours at my hourly rate to do that. So I need to find another way. So you have a business that multiplies your ability to create income. And then there's what we call dry powder. This is because a lot of those funds I was talking about, remember I was talking about how we have investors investing into venture capital and private equity. Well, what happens is that when weird times happen, and let's face it, we've got some weird times at the moment after the COVID where we had A lot of venture capital expenditure into all sorts of things. So those funds were paying out and buying things and going crazy on investing in the early days of AI and a lot of software as a service models, everything from Zoom through to, well, you name it. If there's a piece of software you're using, chances are it was involved in this period about 2021, right? But what's happened now, things have slowed down. There's no shortage of investment money. There's more investment money available than ever before in the history of humanity, but it's not getting spent. The idea is it's sitting in those funds, and instead of immediately moving out and being invested into businesses like yours or ideas like yours, it's sitting there. And the investors are feeling a little bit shy about investing right now. There seems to be a movement of people not really wanting to spend the money or invest the money that's sitting in these funds. And because it's sitting there in a keg, not being used, I kind of refer to it as dry powder. It's not really doing anything. It's not becoming, the squishy mud that we can actually build businesses out of. It's just dry powder, just sitting there dry. So that's expected to turn around by late 2025 if you listen to all the analysts. But look, in essence, that's a very American problem, not really an Australian problem. Some of the bigger private equity firms may be impacted by that because of their exposure to America. But in reality, in Australia, we're not quite at the scale that affects us as much, but it is something to be aware of as you're moving into perhaps looking to get your business invested in 2024. 2025 might be a better year. You never know. Now, the investor mindset, getting inside the head of the mindset of the investor is really about understanding their tolerance of risk. So when we look at that, we're looking about the investor wanting to get the most amount of returns that they can for the minimum amount of risk. Sounds like life, really. We want to be able to do the best things we possibly can without having to risk everything on it. We don't want to bet the farm or at least bet the quarter acre property on some kind of get rich quick scheme if we don't end up getting rich. That's a bit of a risk there. So that's essentially what the investor thinks. They look at what can we get the multiple for our investment and the most amount we can possibly get without too much risk of losing it. Remember those funds I was talking about, these equity funds and the venture capital funds? They could have in any fund up to 10 different investments going at once, maybe five, three. They've got multiples in there. Now, the expectation is that perhaps not all of those investments will work out perfectly. Some of them might be a little bit slow and sluggish. They might give you a return on investment, but not a huge one. On one of them could be what we kind of refer to as unicorns. They just go ballistic, right? They go gangbusters. They go from being valued at $100,000 when they were first invested in through to $1 billion a couple of years later. They're very rare, but when they do happen, they certainly put they buy a lot of champagne for the celebration down the track. So what we're seeing here is that risk that comes in there is a little bit more leveraged than what it would be, say, in a bank loan. A bank loan just looks at you and says, we're going to bet on you, but we have to get that return. If we don't get the return, we're going to chase you down for the rest of your life until we get that return. They don't like to write things off. The venture capital world or the private equity world says we've got multiple risks all going at once. Some of them are riskier than others, but we think that those really super risky ones could get us a big return if they work out. If they don't, we've got other ones to help moderate that out. So overall, venture capital does outperform the stock market over the last 10 years. In fact, if you even look after the last 20 years, it has outperformed the stock market as a form of investment. So you've seen a lot of those, retirement funds in the US or the superannuation funds here in Australia become really interested in private equity in the investment space. Now, they have traditionally just gone through venture capital firms and private equity firms, but what we're starting to see now is them setting up their own investments directly in companies themselves, particularly where there is a better risk profile. They are still massively risk averse. They want to get the maximum amount of return on their investment for their members. But at the same time, they want to really minimize that risk. So they're probably not as risk crazy as what these investment firms are, but they represent the biggest investors in those firms. So they certainly are starting to change their tune a bit. As we move into this, we balance it out by basically that risk by saying, okay, we're going to diversify the investments in a venture capital fund or a private equity firm, perform really thorough due diligence. I know that here within our own in-house investment venture capital fund, which is the Paspalis Innovation Investment Fund, we have a very stringent due diligence program that's performed on everything we look at. We don't just say that looks cool, let's go. There's a very strategic look at it where we go deeply into the financial health and other matters of the businesses looking to be invested in. And the other thing is too, we want to be able to see that there's an exit strategy one day. We're not really interested as investors on being in things for 20 years. We're not looking to invest in, property, housing, things that are going to require a long-term strategy to make them work. We're looking at how do we get out in the life of that fund? And the life of a fund could be about 10 years. So between 2 years and 10 years, we want to be able to exit that business, exit that investment, and move on to other things, get the return for our investors and for ourselves, and then be able to move on to the next thing. The investor's perspective is very much about looking for how viable your market is. So is there a market there? Do people want to buy what you're selling? Is there some kind of novelty or innovative edge, something that's different that's going to attract people who want to get in there? Is it something new, particularly in the case of, is it something which can be protected via trademarks or patents because they become incredibly valuable? Not just the business itself, but the intellectual property you own is often the highest price of value, the highest priced asset that you can have. Then there's also the capability of your team. Have you got a team who are able to carry this out? Does that make it feasible that you can actually build this thing? Have you got a united enough team with enough different talents that cover a lot of different areas to be able to produce this? And then there's the financial health and projections. So have you got, projections that show how much you're expecting to earn, how much you're expecting to sell, what your margins are going to be, whether that's an attractive thing for someone to invest in. They obviously don't want to invest in something that just breaks even. Whilst there are impact investors that are available who may be looking for a little bit less return on the investment money-wise and might be looking more for what the impact is, they still look for an investment, a return on their investment. They're not doing this for charitable reasons. They're doing it to make money. They just have perhaps a thesis which says, yes, we're going to only go through impactful things that have some kind of environmental, social, or governance reason behind them. And then what I just said, the thesis. What is the thesis of that particular fund? Is it an impact investment where are they saying we only invest in things that have a positive contribution to climate change? We only invest in things that have, social justice values associated with them? Or do we just invest in space or tech or resources or small business? There's not really a lot of small business investment going on. Usually the idea is to get out of small business and into much larger businesses, or at least take small businesses and scale them up to much larger businesses down the track. The key investor criteria that's usually looked at, and this is again different for every fund, starts off with market opportunity. They're looking for startups that have a very clear pathway to a market that's ready to buy what they're selling. It needs to have a really clear idea of how big that market is, how big that market could grow, how fast it could grow, and what the potential share of an existing market they have. So, for instance, you're building a new computer. You want to put that computer out in the marketplace, knowing full well that there's a lot of players out there already. If you have the ability to sell 1 million computers in a year, that's great. But if there's a market size of 100 million computers out there, your market size is only 1%. So that's not as attractive as someone who comes in and says, we want to take 14% of that market. So have a very clear idea of what your market opportunity is. There's the business model. Is it the business model is actually able to grow? Investors want things that are easily scalable, things that can be easily duplicated, and obviously profitable. Profits are where the big money is. From the business model, we move on to product differentiation. Have you got a product that actually serves someone's problem or solves their problem or serves them in some way? It could be a technology, it could be an idea, it could be a completely innovative approach to solving that problem that is your special sauce. This is where it's like, what do you do that's different to what everyone else in that space does? So if you're perfecting a skincare product, What does your skincare product do that no one else does? And quite honestly, it probably doesn't do anything different in the case of skincare, which is a very uninvestable kind of business, unless it's tied to a brand that is incredibly strong and people will buy it just because of that brand. And you show some traction that shows that people are already doing that. Traction is what I'm talking about. It shows the evidence that you've actually got some sales, you've actually got some partnerships, you've got that first customer. That radically influences the decision to invest in you because it shows that not only if you said, yes, the market's going to love this, but the market actually is loving this. From there, we go on to your team's expertise and leadership. Have you got good leadership? Have you got people who are, capable of doing the things you need them to do? A great chief financial officer can keep on top of all the tax stuff. Have you got a product development person, maybe someone who is your brand expert who knows all the marketing, or you've got a really top-notch salesperson? The ability for you to be able to technically carry out what it is you say you want to do is absolutely vital. There's no use saying we want to do this if you don't have the ability to then do it. Sure, you may not have all the pieces of the puzzle, but having at least 80% of those pieces really helps because you can always hire more people who have those specialty expertises. The financial projections, well, that's obvious. We want to make sure that there is profit margin in there. We want to make sure that if you have investment, that you're not burning that investment money too quickly, like some of the glamour, someone from the Silicon Valley, for instance, in areas like Uber, who burn through so many billions of dollars, or WeWork, which is probably one of the most famous ones, where they burn through billions upon billions of dollars in a company that's just about to go under. And then we want to look at an exit strategy, the ability to get out. That sky quite often can be an acquisition by another company. They buy it out, so the investors get their money back plus a percentage. It could be a merger with another business, which makes the business much more viable and bigger. Or it could be initial public offering. We haven't had one of those in Australia for quite a long time. But what it is basically you go on the share market so that you then get billions of dollars coming into your business and people buying shares of it. So they're usually going to be minority shareholders because the founders generally have a majority shareholding. They don't really like to dilute too much. So why is all this important? Simply because it aligns with their business strategies. If you focus in on those criteria, it helps align your strategy with the reality of the market and what the investors expect to get as a return. And that's what you need for that long-term success because you really need if you want to grow fast, you're not going to do it on your own. No one's going to magically give you money to just make your dreams come true. That's not the way the world works. People invest in things that have a significant return attached to them. What it does, if you go through this process, it improves your market fit because your market size and your product differentiation need to be all aligned so you can make your product work for that. There's no use putting people in a pair of shoes that don't fit because they'll just take them off again. So if you've got a fit for your product to fit the market that wants it, you're going to have a great product that's going to grow. You want to also attract multiple investors. It's going to take more than just one investor to make this happen for you. If you're going to go big, if you want to create a $100 million company, you don't do that with one investor coming in and giving you $1.5 million. You're going to need more along the way. And what it does is when you meet these key criteria, you actually get the attention of lots of investors who want to walk in and say, hey, we'll take a piece for this, we'll take a piece for that. And it gives you a big edge and it gives you a lot more negotiating power when you sit down with a venture capital firm, as opposed to if you've only got one person interested, you don't really have a lot to go. If you've ever seen Shark Tank or Dragon's Den, you know what it's like when the sharks are circling. They all want a piece of this idea and it gets competitive. You want that situation because it gives you more money in your pocket and it also maintains more control for you when you need to keep that. And it also enhances your credibility and trust because it shows that your business meets the criteria. And so it makes them trust you more. If you go to the trouble of meeting the criteria, they will come forward to you. In fact, usually what they'll do is they'll find you. People like me are constantly out there looking for opportunities like these. So if you're already fulfilling those criteria, you get picked up first. Or when you do approach places like a venture capital firm for investment, you're far more likely to get the attention and the trust of them. And of course, the whole thing is about facilitating the business to be able to grow and be scalable. When we say scalable, we mean quite rapid growth, not just 2 times growth. I'm talking 10 times, 100 times growth. That becomes a much more attractive firm to work with. So, what you need to focus on then is the market opportunity. How big is the market you're going for? How are you meeting their pain points? And how are you showing that you've got a clear focus and a plan to capture enough of that market share? What is unique about what you're doing? What is the thing, your special sauce? What is the thing that you do that no one else either can or is unlikely to, but you found a way to do it? This is not just, we're not just looking for, a business that just duplicates what other businesses already do. We need to see businesses that do something that nobody else has been able to do. They've found a way, they've got an approach, they've got a product that fills a gap that we didn't even know was there. Have best scalable business model. You can grow rapidly or you can grow massively. Not something that can just double its size in 5 years. We're talking something that can 10x, 20x, 100x its size in that amount of time. Also, your team. Hire the right people, work with the right partners. Even if you are not yet at that point where you can hire people, partner with the right people. Get some traction. I cannot overstate or how important it is to get that first customer. If you have that first customer, that says you have traction. You're not just getting stuck in the mud. You're actually making some movement. And go through a validation process. And we do a lot of that here at the Darwin Innovation Hub. One of the first meetings we ever have is to look at, is this startup actually a thing, or is it just someone's dream? Because dreams don't necessarily equal dollars. So we need to work out whether this idea they've got is actually real and whether it has an actual valid reason to be existing.